Hello everybody, welcome to a video I haven't done in a while, which is the cheapest hypergrowth stocks in my spreadsheet. So really briefly, as you know, if you've been following the channel for a while, I screen hundreds of stocks and I share this spreadsheet on Patreon. It's actually the most popular part of the Patreon based on the data I see. But it's getting tough because it's tough to find a stock that as it all and as it all for me, right? So it's going to be different for different people. But, ideally me, I want a stock that grows pretty fast, 30% year over year on average, and you can compound that and by 30%, I mean not growth in the stock price, growth in the sales. I want the revenue to grow at 30%, and if the price to sell stays the same year after year, price to sell stay the same, your revenue growth should be the growth of your stock, if that makes some sense. The stock should grow the same as the speed at which your revenue grows if the price to sales remain constant. So that's why I focus on revenue growth a lot. I want at least 30% because that's twice the US dollar debasement. So I want my stocks to take in twice as much dollars as we are getting debased each year. But I also want the stocks to be gross margin optimized, obviously, but also EBITDA margin optimized. EBITDA margin optimization is important for me. It's a proxy for cash flow. If you have positive EBITDA margin, as far as I'm concerned, and I'm not dogmatic with GAAP or anything like that, but as far as I'm concerned, positive EBITDA for me is positive cash flow. That's what I want. So this type of stocks that I focus on is, I would say, one notch above Cathie Wood's type growth stocks, but it is definitely one notch under, say, an Amazon or an Nvidia or a Google. For example, my Nvidia, I would put it perhaps in the bucket of hypergrowth at any cost, right? I own Nvidia, I own Palantir, I own Tesla. These companies are hypergrowth. They're the best in their space, in my opinion, but they don't look cheap at all. Except I don't want to miss out because you have a lot of people who argue valuation don't matter at all, and it's true. A stock can do a 10x and have a price to sales of 20 times. All the way to a 10x for 10 years, right? I'm not trying to bet on multiple expansion or multiple reduction because stocks can remain expensive for 20 years. And so that's why I have a bucket which is hypergrowth at any cost. And I just look at the growth of the business and I assume the valuation is going to stay roughly the same. But this is my bucket of growth at a deep value, So I want the growth to be there, but I want that growth to also be very, very cheap. And by the way, I consider in this spreadsheet, a stock like HIMSS. A stock like HIMSS, to me, I consider it almost a hypergrowth at any cost type stock. If HIMSS were to be on the EV over GP over RG ratio, if HIMSS were to be like a 1, I would likely still keep my HIMSS because I do think it's the best stock in the telehealth sector, right? That makes sense. And then, my Bitcoin stocks, the channel is called Beat the Denominator. Come on, I'm a Bitcoin person, so I think the best way to beat the denominator fiat, is just to escape towards the next big thing, and the next big thing, in my view, is going to be Bitcoin. Ideally, I would have the best of both worlds, right? A stock that is high growth at a deep value, but also the highest quality growth in its sector, and that also adopts Bitcoin, right? So give me a HIMSS buying Bitcoin, and that would be that stock that fits all of these three buckets. So today I talk about growth at a deep value type stocks. And the main metric by which I judge these stocks is enterprise value over gross profit over revenue growth. This is my modification, my humble modification. I am no Peter Lynch, but my teeny tiny modification to Peter Lynch's PEG ratio. And how do I modify it? I use the enterprise value because I want to penalize companies that have too much debt. I use gross profit because I think in the 21st century, a lot of operating expenses are actually investments. I don't consider R&D or marketing costs to necessarily be a cost. I consider that these costs are an investment into the future and that they'll be recouped. I think it makes sense for a company like Hims to say spend $500 worth of advertising to get one subscriber for ED drugs who is going to stick with Hims for 15 years, right? This is the same reason why Amazon was ignored by the market for well over a decade, called expensive by the market for well over a decade, because people didn't understand that operating expense was actually an investment into the future. GAAP has not caught up with businesses in the 21st century. GAAP is stuck analyzing, say, an automobile company from the 1950s, where, if you spend $7,000 of advertising on a Lexus to sell a Lexus, it's tough for you to argue that's going to be repeat sales. No, he just did a one-time cost, a one-time fee, a one-time selling fee, a one-time transaction cost. In that case, that's a cost. Anyways, I remember revenue growth. I use revenue growth. It makes sense to me. Why does it make sense to me? Because revenue growth is my main criteria for selection to begin with. Sales growth, right? Sales growth is the main criteria. That's the top line. My love for sales growth, by the way, has to do with the fact that you can't massage these numbers. You can't make these numbers look better. Sales is sales, period. Sales are sales, period. So that's what I like a lot about this. And that's also why you remove the debt, because you want to be careful about revenue financing. Take the GMs of the world. Yeah, they have sales, but these sales are financed by them, right? That was the GE story. GE had a bunch of sales, but they didn't realize those sales were financed by the GE financial division, and that's how you had the GE disaster. So anyways, let's go, and Rule of 40, lastly, Rule of 40 is an addition, something I like very much. It comes from the SaaS world. Frankly, I think it's applicable everywhere. The Rule of 40, measures the balance between really profit and growth, and the idea is that when you add revenue growth, and in the case of my spreadsheet, I guess it's a modified Rule of 40. I use EBITDA margin. When I add EBITDA margin plus revenue growth, I want more than 40. This is a VC metric. VCs typically don't look at businesses that don't achieve a Rule of 40. And all of these businesses handsomely achieve a Rule of 40. So let's go. Let's talk about the first stock, LifeMD. LifeMD is baby Hims, mini Hims, whatever you want to call it. Both businesses are becoming more and more competitors, quite frankly. Hims is getting into tougher health issues, and LifeMD is expanding into the pharmacy business, which Hims always had the pharmacy business. LifeMD started its pharmacy. So they're looking more and more like competitors, but there's really no competition because Hims is so much bigger than LifeMD. LifeMD is a nice position for me. I find the stock a little expensive right now. I think it got ahead of itself at $12. There's a little bit of a squeeze happening from what I understand. So I'm not actively adding to LifeMD right now. I actually find Hims to be the slightly better deal right now. Hims at 55 or 56. I find it a good deal, because when I look at the quality of Hims, to me, Hims is probably already a $100 stock, probably, in my view. But that's just me. So Hims is my third largest position, big position in the channel. On this channel, we're talking about Hims when it was trading at $6. We were late. Twitter was talking about Hims when it was trading at $3. I remember Investor in Innovation, one of the commenters on the channel. He's not there anymore. I don't know where he's. Anyways, from the UK, who was there in that stock at $3. But anyways, we got late. 6 to 9 was covering it a lot. I remember when I found Hims. Was it 2 years ago, almost 3 years ago now? I had an epiphany moment. I was like, whoa, this is going to be a much bigger company. And now Hims is like a mainstream retail stock now. And you have people saying Hims is going to do 100x and compete with Amazon. As far as market cap size, not necessarily compete head-to-head with Amazon. Hims is a holistic vision of a new form of healthcare, a healthcare that is fully out of pocket, a healthcare that doesn't use insurance, a healthcare that you just pay out of pocket because healthcare has become cheap. Because from the moment you remove insurance, from the moment you introduce AI, from the moment you introduce enormous automation, Hims has now 3 fully automated warehouses. They expanded the one in Arizona. From the moment you introduce vertical integration, Hims now is so vertically integrated. They make their own compounding medications, they make their own marketing, they make their own care via a platform of doctors, and they even make liraglutide. They even make their own peptides. So it's like so you could have Hims be a Teva, a medical provider. Teva Pharmaceuticals being a maker of generics. We have someone on the board, a pharmacy, a provider, a marketer, I mean, it's all holistic, and in my view, HIMSS is able to do that because they don't take insurance, and that's the big deal. I think LifeMD is growing more slowly than HIMSS because LifeMD takes insurance, and when you take insurance, you can't compound as fast because you gotta apply for reimbursement, and it takes 6 weeks, 4 weeks. If you ever watch doctor videos, doctors will complain a lot about that. They'll be like, okay, well, it takes me forever to get paid for my services by insurance XYZ. And sure, you get paid, but that really hurts your velocity of the money, doesn't it? Because, HIMSS is instant. You get paid right away. HIMSS can move as fast as a company like Amazon. And Amazon, surprisingly, didn't get it, because Amazon tries to get your insurance payment. So it's to tell you how entrenched this industry is. I believe with automation, we can get healthcare cheaper than copays. And to me, that's the big vision of HIMSS. And it's cheap, of course, because healthcare revolutions are not understood yet. I think it's going to be the next big thing. Healthcare revolutions are definitely not understood by the market. Of course, biotechs, and that's a different space, but biotechs have always been seen as this kind of risky thing, and people are ignoring the exponential growth that is going under the hood of some of these companies. I'll go to two companies that I like. So these two, Delcath and Cormedix, and I'll get to BioStem in a second. So you're noticing a big healthcare tilt. The market doesn't get healthcare, I guess. These healthcare companies are also cheap. So Cormedix. Let's talk about Cormedix. Cormedix is a dialysis business. I've covered Cormedix many times. I like Cormedix a lot. Look at that EBITDA margin, 60% EBITDA margin. Gross margin in the 80%. Forward, next 12-month growth predicted to be 180%. The rule of 40 is 240, and the business is trading at less than 4 times forward sales. Think about that, less than 4 times forward sales. Enterprise value over gross profit over revenue growth is a 0.07. This one is dirt cheap. What I like a lot about Cormedix is that their product is a catheter lock solution. So it's a vial, and whenever people have a kidney failure, they go on dialysis. And when they go on dialysis, every 3 days you go to dialysis. When you go home, you bring your tubes with you. Your tubes that are connected to your kidney, you bring them with you. And you can get infections. And when you get infections, it could be a $70,000 bill for Medicare, and it also is very much life-threatening, and you may die because of that infection. So what Cormedix does, they sell a vial, and once you're done with dialysis, they open the vial and they drop the vial in the catheter until your next visit, where they just remove the fluid, do the dialysis, and then close the vial, close the tube again with the solution, which is the FDA-approved solution that Cormedix sells, and the FDA. It's not the FDA this time, it's the CMS, the Medicare Services Center, is very keen to pay for this because it's all about reducing the infection, because Medicare loses a lot of money whenever there's an infection, and it's a relatively cheap product, right? It's $200 a vial or something like that. So it's a relatively cheap product, and it saves a lot of money to Medicare. That's why I think it's mostly safe. I love that play very much. It's up 171% year to date. Delcath, another catheter business. So Delcath, that's in the liver cancer business. So it's a system to have a targeted chemotherapy on only the liver. The liver is a very tough organ to operate on. When you have liver cancer, it's a very sad story. This product is getting adopted by a lot of hospitals. It seems to be taking the world of oncology a little bit by storm, based on what I can tell. And it works with catheter. So what they do is they isolate the liver, catheter up, catheter down, and then they have a filtration machine where they can do the chemo only on the liver without hurting the rest of the body. And then they remove something like 80% of the chemo. Anyways, I'm not a doctor, but it seems to be pretty successful, and a lot of people are very happy about it. And of course, a company like this, which could be very much life-changing for cancer patients, a company that literally saves lives, of course, is being dumped by the market, trading less than 4 times sales. Enterprise value over gross profit over revenue growth is a 0.07. Rule of 40 is a 180. To me, this is an asymmetric bet. To me, this is an ignored stock, and I'm happy to own it. Moving on to one of the two only stocks that is not in the healthcare in my cheapest stocks in the universe, and that stock I don't own, but it's gambling.com. So from what I understand, they operate a bunch of websites, where you can, I don't know, play and win money. It's a digital casino. It's the only way I can describe it. It's a digital casinos. As casinos as they are, they're almost pure margin, 94% gross margin, 33% EBITDA margin. They're investing in marketing to grow. That explains a lot of that delta between gross margin and EBITDA margin. Is a big cost of this is marketing. You could argue they could spend more. They could drop that EBITDA margin. They could spend more money on the marketing, and so then it's all about your marketing efficiency, right? If gambling.com wanted to have an EBITDA margin of 1%, they would have so much more cash that they would invest in marketing, and that would lead to a higher revenue growth. Anyways, they're finding the balance. The balance that they found is a 54 on the rule of 40, so not quite as good as a lot of what we see in healthcare, but not bad either. Gambling is not a sector that I know much about, so I'm not too interested in the sector just because I don't know it as much. But make no mistake, this is a stock. If this stock ever dumps and gets below a 0.1, I would be interested, because at the end of the day, when a stock is too cheap to ignore, it's tough. Oh, a stock I didn't put in there that I could have put. I forgot. Oscar. I could have put Oscar in there. I forgot to put Oscar in there. But Oscar is still in the health business. So anyways, another stock, another healthcare business. I'm sorry, if you don't like healthcare, this is not the video for you. Another stock is BioStem. BioStem, best comment in the history of the channel. I'm not investing in placentas, bro. BioStem is they're taking placentas, donations of placentas, and they're turning them into bandages. There's no better way to say it. It's called AmnioWrap, the business, and these bandages have a lot of advantages in wound healing. Now, the stock is the cheapest stock in the history of the channel at a 0.01. So that's effectively 7 times cheaper than a Cormedix or DefenCaf. That's 4 to 5 times cheaper than HIMS ever was when HIMS was trading in below $6. So it's 5 times cheaper than HIMS ever was. There's a few reasons why it's so cheap. It's OTC. You can't get it on a lot of brokers. That's one reason they need to do a NASDAQ uplisting. They are going back and forth with the SEC as to how to deal with revenue recognition. So it's not a confrontational back and forth, by the way. It's literally just accounting questions into how they treat their business, and they're waiting to hear back from the SEC to finish this process so that they can get an uplisting, and so that they can be available on more exchanges. So I think it's a big reason as to why this stock is so cheap. I think this stock should re-rate perhaps violently once it gets uplisted to the NASDAQ. Perhaps. I don't know. The point is, forward revenue growth is 80%. Which is excellent. Gross margin is 97%, right? They get them for free. Women typically donate placentas, but they get them for free. EBITDA margin is 10%. They're investing in their growth. The main risk of this company, which is a risk that I'm willing to take, the main risk of this company is that they may be off the list on the LCD of CMS. And, if you know anything about that, if you know anything about, say, Semler Scientific, that being off the list is oftentimes how medical companies die. They're off the list. That's why I love Cormedix so much, because I don't think Cormedix is going to be off the list, because I don't think CMS is going to stop paying $200 to remove infections from patients. I don't see that happening. I don't think Delcath either. I think CMS is going to pay for cancer treatment. BioStem, people argue you can use a xenograft, which is typically made out of pork skin, and it's a cheaper type of wound dressing than a placenta wound dressing. So this company has a lot of moving parts, but in my view, I'm being compensated for that risk because it's so cheap. It's 0.01. It's so cheap. So in my view, I'm being compensated for that risk. And keep in mind, even if it's off the CMS, the product can still be used in private clinics. They're working on more and more distribution. Just the standard private clinic distribution could be enough for this business to be sustained. Keep in mind, this is a business don't even use my ratio here. My enterprise value over forward revenue ratio is a 0.4 times sales, so it's trading at 0.4 times sales. But just look at that. Revenue is 302 million. Enterprise value is 230 million. And they have an 97% gross margin, and they have a 10% EBITDA margin. So, and they still spend a lot of money on R&D and marketing and distribution. So that delta is actually a lot of an investment. Between the 97% and 10% here, there's a lot of percents right there that go into an investment. That is not like pure operating costs. So anyways, that's just what I think. And the last one, and I own, of course, BioStem. The last one, which I don't own, I do not own Chinese stocks. Every 3 to 6 months, I wonder why I don't own Chinese stocks, because alpha is alpha. But I always go around to not owning Chinese stocks. I don't own Chinese stocks. I don't own PinDuoDuo. I would consider PinDuoDuo to be risky right here, because PinDuoDuo has become a European play essentially, because now with Temu. So PinDuoDuo own Temu's. PinDuoDuo, really quickly. PinDuoDuo means shop friends fun, shop with friends for fun. Very popular in China. And the Chinese version of the app, is not threatened, but the European and the American version of their app is Temu. And so Temu, if you ever use Temu, you understand why shop friends fun, because it's all about buying together, etc., etc. And Temu in the US, with the de minimis exemption going away, I don't think it's going to be that brilliant in the US now. PinDuoDuo, a lot of people say, well, they're just going to double down on Europe, and they're just going to dump more cheap packages on Europe. And of course, the Europeans want to remove the de minimis exemption too, but from what I understand, they have to wait until 2028 before they can do anything about the de minimis exemption. So if you're in Europe, enjoy the inexpensive packages from Temu, because they're essentially gone here in the US now. And it's quite amazing that this company is so cheap for the size of this company, but it operates in China, and that's probably the reason why. If most equity investors think like me on China, they probably think about investing in China every 3 months, and then they have a 1-800 number that they call in order to not do it. This is a famous Warren Buffett quote. Whenever he wants to buy an airline, he has a 1-800 number for support, so that they prevent him from even buying an airline. I think Chinese stock is kind of the same way for me. I think there's a lot of good things going on for these companies. They're very, very cheap, but it's I just haven't made the move. I just haven't made the move. And if I did make the move on a Chinese company ever, that wouldn't be PinDuoDuo. I consider PinDuoDuo to be too risky because of the trade tensions. So anyways, this was not investment advice, not financial advice. This is only entertainment. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.